You have probably watched 50 different videos on supply and demand zones. You have drawn 1,000 boxes on your charts, and yet price still blows right through your zones like they are not even there. The problem is not the strategy, but your lack of systematic filter. In this masterclass, I am going to end in this confusion. No more guessing of which zone will hold the price. I am giving you my exact 3 criteria framework to grade a zones from A plus to debt. By the end of this video, you won't just see boxes on your chart, but see the logic behind the market. Grab your notebook. This is the last supply and demand video you will ever need to watch. Welcome to what I genuinely believe is the most complete supply and demand breakdown you are going to find anyway. I have spent decades on this video researching, analyzing, scripting, recording over recording, and then edited for just making this video as understandable as ever seen like. My name is Modu, and today we are going to go through everything you need to know about supply and demand zones, from absolute zero to a level where you can confidently identify these zones, understand why they form, know when they are valid and also when they are dead, and most importantly, know how to actually trade them for real entries with real stop losses and profit taken. Here is my promise to you. By the end of this video, you will understand exactly what supply and demand zones are, why they actually exist in the market. You will learn the 3 criteria I use to validate every single zones. You will see how to identify them on live chat in real time. You will know when a zone becomes invalid, which is something most courses completely skip over. You will learn the most common mistakes that destroy beginners. And finally, you will learn a complete entry model so you can actually trade these zones with a defined plans. You don't need to watch 5 other videos first to understand what I am talking about. Every concept I mention will be fully explained right here, right now. One thing I ask before we start, grab a notebook or often a notes application on your phone. There are specific frameworks and rules I am going to giving you throughout this video that you are going to want to write down. I promise your future self will thank for it. Alright, let's get into it. What are supply and demand zones and why they exist? Before I show you how to find these zones, you need to understand what they are and why they exist. Because if you don't understand the why behind them, you will never fully trust the method, and you will second guess yourself every time you are about to take a trade. So let me start by asking a simple question. Who actually moves the market? It is not you, not me, and also not a retail traders sitting at home with a small account clicking buys and sells. But the market is moved by an institution, banks, hedge funds, central banks, and the large money managers. These are the players managing billions of dollars in capital. And here is why. The things about managing billions of dollars. You cannot click buy and get filled instant at one price. When a major bank wants to buy 2 billion worth of Euro USD, they cannot just do it in one order because the market simply doesn't have enough liquidity at any single price level to absorb this kind of size. So what do? They break their orders into chunks. They accumulate their positions over a period of time at a specific price range. And when they finally have enough of their position filled, they let the price rip to their intended direction. That's aggressive, explosive move away from a price level That is what creates a supply and demand zones. So let me give you the clear definitions. A demand zone is a price area where aggressive institutions buying cause price to shoot up rapidly. There are likely unfilled orders still sitting at that level because the institution could not get their entire position filled in one visit. When price return to that area, those remaining orders can activate and push the price up again. A supply zone is the exact opposite. It is an area where aggressive institutional selling cause price to drop sharply until sales order remain at that level. When the price comes back to those orders can activate and push the price down again. Let me put this in every term so you really click. Imagine you walk into a store and they are selling a brand new iPhone for $50. Everyone in the city rushed to that store to buy one. Within minutes, the store is completely sold out. But there are still hundreds of people waiting in line who did not get one. Their demands has not disappeared. They still want that phone at that price. So when the store is restocked and the price come back to that level, all those remaining are still waiting to buy. This is demand zone. And now imagine the opposite scenario. A store announces they are buying used iPhone for $2,000 each. Everyone rushes to sell their old phones. The store runs out of cash before they can buy from everyone. But the sellers keep showing off. When the store gets more funds and the price returns to that level, those sellers are still lined up ready to sell. This is supply zone. This is fundamentally why supply and demand trading works. You are not drawing random boxes on chart and hoping price react. You are identifying where institutions place massive orders. You are identifying where they have unfinished businesses, and you are positioning yourself to trade along them when price returns to complete that business. Now, obviously, not every price level is valid zone. You cannot just draw boxes at every swing high and swing low and expect all of them to work. So how do we separate the real high probability zones from random noises on the chart? That is where the three criteria comes in. But before we get into the framework, there are 4 key terms you absolutely must understand first, because I am going to use them consistently throughout the rest of the video. Let me define each one clearly right now so there is zero confusion later. The 4 key terms you must understand. I am going to walk you through these 4 terms right now. If you already know them, this will be a solid refresher. And if you don't know them, pay extreme close attention, because every single thing I teach from this point forward depends on understanding of these 4 concepts. The first term is inefficiency, which I abbreviate as IFC. You might also hear this called as an imbalance, IMB, or fair value gap, FVG, in order trading concept. It is the same exact concept, just different names. An inefficiency is created when price moves so aggressively in one direction that it leaves a gap between wicks. Let me explain exactly what that means. 3 candles in a row. The first candle is the relatively normal size. The second candle in the middle is massive It shorts off so aggressively and so quickly. And the third candle opens and trades in a way where its lower wick does not reach back down to the first candle's higher wick. There is a visible gaps between where candle 1's wick end and where the candle 3 wicks begin. That gap is the inefficiency. The price moved so fast through that area that it did not trade fairly. There was a complete imbalance between buyers and sellers in that price range. One side completely overwhelmed the other. Now, why does this matter for supply and demand trading? Because the market has a natural tendency to peel inefficiency. Price doesn't like leaving gaps. It is drawn back to this area like a magnet to rebalance and trade through them properly. So when a supply or demand zone has an inefficiency attached to it, price is significantly more likely to return to that zone. The inefficiency acts as a magnet, pulling price back to that area. A zone with inefficiency has a much higher probability of being revisited than a zone without one. This is a critical decision that will save you from making weak zone on your chart. And also keep in mind that the size of the inefficiency matters. A small gap between wicks is technically an inefficiency, but it is a weak magnet. A massive gaps between wicks, that is a powerful magnet. Price always comes back to peel those large inefficiencies. As a practical guidance, I look for inefficiencies where the gap is meaningful and clearly visible on the chart. If you have to squint and zoom in to see whether there is actually a gap, it is probably too small to rely on. Write this down. Inefficiency is equal to the magnet that pulls the price back to zero. Term number 2, break-up structure. The second term is break-up structure, which I abbreviate as BOS, boss. This one is straightforward once you see it. In a bullish trade, price creates a pattern of higher highs, higher lows, higher highs, higher lows. Each new higher is higher than the previous high, while each new low is higher than the previous low. That is what defines the bullish trend. Every time price breaks above the previous high point, that is a breakup structure to the upside. A bullish boss confirms that buyers are still in control and the uptrend is continuing. In a bearish trend, the opposite is true. Price creates lower highs, lower lows, lower highs, lower lows. Each new low is lower than the previous low, and each new high is lower than the previous high. Every time price breaks the previous low point, that is a break-up structure to the downside. A bearish boss confirms that sellers are in control and the downtrend is continuing. The key thing to understand about break-up structure is that it is continuation signals. It tells you the current trend is persisting, and the side in control just proved it again by pushing price beyond the last extreme. Think of it as market saying, yes, the trend is still alive, and the dominant size just scored another point. Write this down. Breakup structure is equal to continuation. The existing trend just made another move in its direction. The term number 3 is change of character. The third term is change of character, which I abbreviate as CHOC. This is the one which confuses most beginners, so I am going to be very precise here. A change of character is the first break of structure in the opposite direction of the current trend. Let me walk you through it step by step. Imagine we have a bullish trend. Price has been making higher highs, higher lows for a while. Everything looks great for buyers. Then boom, something shifts. Price fell to make a new high. It rolls over, and for the first time, it breaks below the most recent higher low. That break is change of character. It is the market's first signal that the bullish trend might be over and a bearish reversal might be starting. Now, here is the really important distinction between break of structure and change of character, because this is where most people get confused. A break of structure is the continuation move, price break in the same direction as the existing trend. Bullish trend makes a new high that is boss and trend continues. A change of character is a potential reversal signal, a price break in the opposite direction of the existing trend. Bullish trend breaks below the last low for the first time. That is change of character, and the trend might be changing. Boss means same direction. Chalk means opposite direction for the first time. And here is the critical points of supply and demand trading. Each time a chalk occurs, it automatically creates a zone at the origin of the moves that cause the chalk. If we were in a bullish trend and a bearish chalk happens, the candle or group of candle that cause that downward break becomes a supply zone, because that is where the sellers first overwhelm the buyers and shift the control. If we were in a bearish trend, a bullish chalk happens, the origin of the upward break becomes a demand zone. That is where buyers first overwhelm sellers. Chalk zones are often the most profitable setup you will find, because you are catching a very beginning of potential trend reversal. You are getting it right when control shift from one side to other. Write this down also. Change of character is equal to the first break in the opposite direction. It signals potential reversal and automatically creates a zone at its origin. Term number 4, which is liquidity. The fourth and final term is liquidity. In the context of supply and demand trading, liquidity refers to cluster of orders sitting at predictable levels in the market. Specifically, we are talking about stop losses orders. Think about it. Where do most traders places their stop losses? Above swing high or swing loss. It is the most obvious and most commonly taught placement. Every trading course in the world say put your stop loss below the swing low if you are long, and above the last swing high if you are short. And because everyone does it, this level becomes loaded with stop loss orders. Those clusters of stop losses are what we call liquidity. Now, here is where it gets interesting. Institutions know exactly where retail traders place their stop loss, and they use those stop losses as fuel to their own orders. How does that work? When an institution wants to sell a huge position, they need buyers on that other side of the trade. Where do they find a massive cluster of buyers' orders? Right above the swing high, because all those stop losses sitting above the swing high are buyers' stop losses. When triggered, they execute as buy orders. That's exactly the liquidity the institution needs to fill their sales orders. So price gets pushed up into those stop losses, triggering them all and giving the institution the buy orders need to fill their massive sales position. Then price reverses aggressively downtrend. This is called a liquidity sweep. Price move to an area where stop losses are resting, triggers them and then reverses. You might also hear this is called a stop hunt or liquidity grab. Same concept, different names. Liquidity also accumulates along trend line. When price respect a trend line multiple times, traders begin placing their stop losses just beyond the trend line. So When price finally breaks the trend line, it sweeps all the accumulation liquidity. Why does this matter for supply and demand? Because when a zone forms right after the liquidity sweep, it is an extremely strong signal that the institutions just grabbed their fuel. They just triggered all those stop losses to fill their orders, and now price is ready to move in their intended direction. A zone that forms after a liquidity sweep has an institutional backing behind it. That is about as high probability as it gets. Write this down. Liquidity is equal to clusters of stop loss orders at predictable levels. Institutions swipe these stop losses to fill their own positions. Zones that forms after liquidity sweeps are the strongest zone. Let's give a quick recap of these 4 terms. So let me quickly recap all 4 terms before we move on. Inefficiency, fair value gap, or imbalance is a gap between candle wicks showing aggressive one-sided price movement. It acts as magnet pulling price back. Break of structure or burst is when price breaks the previous swing high or swing low in the direction of the existing trend. It signals continuation. Change of character or choke is the first break of structure in the opposite direction of the current trend. It signals potential reversal and creates a zone as its origin. Liquidity is a cluster of stop loss orders at obvious levels that institutions target and sweep to fill their own positions. These are your 4 building blocks. Everything from this point forward is built top of these concepts. If any of them are unclear, rewind and listen to that section again before moving forward. I mean it. Don't skip ahead, hoping it will make sense later. Get this 4 locked in your mind first. Good. Now, let's put them all together into the framework that will change how to read the chart. Section 4. The 3 criteria framework. Here it is, the framework. This is the core of everything. Write down word for word. For a supply or demand zone to be considered valid, it must meet these criteria. Criteria number 1, it is mandatory that the zone must create an inefficiency or IFC. Without an inefficiency, the zone has a much lower possibility of price returning to it. Remember, inefficiency is the magnet. No magnet means no reliable pull. Without inefficiency, you are just hoping price come back, and hope is not a trading strategy. Criteria number 2 is mandatory. It's mandatory that the zone must either break structure, create a change of character, or break through an opposite zone on that opposite side. This confirms that the moves originating from the zone was significant. It was not just a random fluctuation. Something meaningful happened. Structure was broken. The market showed its hand. Criteria number 3. This is the bonus and confirmation. Is the zone sweeps or create liquidity? This criteria number 3 is not mandatory as said. I just want to be clear about that. A zone can be a completely valid without meeting this criteria number 3. But if this criteria is also met, the zone becomes significantly stronger. Think of it as a going from good zone to great zone. Now, let me give you a grading system so you know exactly how to prioritize zones when you have multiple options on your chart. If a zone met all the 3 criteria, which are inefficiency plus break of structure plus liquidity, that is an A+ zone. Highest confidence and you can take a trade without hesitations. What if a zone meets criteria number 1 and 2, which are inefficiency plus structure break, but does not have a liquidity component? That is a B plus zone. It is still bullish and tradable, just not as strong. If a zone only meets one criteria or none at all, skip it. It is not a valid zone under this framework. Do not trade it. Let me repeat this most important part one more time. Criteria number 1 and 2 are non-negotiable. Both must be present. If one is missing, the zone is not valid. Criteria 3 is the bonus that upgrades a valid zone into an elite zone. Now let me break down each criteria in much greater details with clear examples so you know exactly what to look for. Section number 5. Criteria number 1, deep dive, inefficiency in live chart. Let's go deeper on inefficiency because it is the foundation of everything in this framework. I have already explained the concept. It is a gap between candle wicks created by aggressive one-side price movement. Now, let me talk about how to actually evaluate inefficiency when you are looking at a chart. When you are analyzing a potential zone, look at the candle that caused the move away from that zone. Specifically, look at the 3 candle sequence: the candle before the big move, the big candle itself, and the candle after the big move. Is there a visible gap between the wicks of the candle 1 and the wicks of the candle 3? If yes, you have an inefficiency. If that wicks overlap even slightly, you don't have a clean inefficiency. Now, not all inefficiency created equal. A tiny gap that barely visible is technically an inefficiency, but it is a weak one. A massive gap that spans a significant price range is a powerful one. The bigger the inefficiency, the stronger the magnetic effect. As a practical tip, I look for inefficiency where the gap is clearly visible without zooming in. If you can see it at normal chart zoom, that is a meaningful inefficiency. But if you have to zoom into 1 minute chart to find a tiny sliver of a gap, that is probably not strong enough to base a trade on it. Now let me explain why zones without inefficiency are problematic. If a price pushes away from a level but does so gradually with overlapping candle wicks and no gap that tells you the move was orderly balanced, then both buyers and sellers were actively throughout the move. There is no unfinished business at that level. There is no gap to fill. And also, there is no magnet pulling price back. Compare that into a zone where price exploded away, leaving a massive gap. That tells you one side completely overwhelmed the other. The move was disorderly imbalanced, and there is unfinished business that the market will want to come back and rebalance. That is the difference, and it is a massive difference in terms of probability. For our framework, I keep it strict. No inefficiency means no zone. This single filter will eliminate the majority of low probability zones from your chart and save you from countless bad trades. It might feel like you are being too picky. That is the point in trading. Picky is profitable. Section 6. Criteria number 2. Deep dive, break of structure in live chart. Criteria number 2 requires that the move originating from the zone must break structure in some way. There are 3 ways this can happen. Option A, break of structure in the direction of the trend. This is the most common scenario. You are in a trend and price create a new zone by continuing that trend. In a bullish trend, price pulls back to an area, consolidating, and then launches upward, breaking above this previous swing high. That is a break of structure. The area where price consolidated and launched becomes your demand zone. The fullback base before the breakout. If the demand zone has an inefficiency from the aggressive breakout move and also has a clear break of structure confirming buyers are still in control, then the 2 out of the 2 mandatory criteria meet. And this is the valid demand zone. The same logic applies in reverses for bearish trend. Price rallies off to an area, stall, and then drop, breaking below the previous swing low. Break of structure to the downside and the area where the price stall before dropping becomes your supply zone. Option B, which is change of character. This is where reversal zones become from, and these are the often most powerful setup. A bullish pumps higher highs, higher lows, higher highs, higher lows. Price has been going up for a while. Then something changes. Price fails to make a new high, it rolls over, and it breaks below the most recent swing low for the first time. That is a change of character. The first crack in the bullish structure. The candle or group of candles that cause this break, the origin of the choke move, that becomes your zone. In this case, it will be supply zone because the choke was bearish. That is where sellers pause to control. If the choke move also created an inefficiency, you have both mandatory criteria that meet the zone valid. And because it is a reversal zone, it often leads to extend moves as an entire trend shift direction. The same applies in other direction. In a bearish trend, if a price breaks above the most recent swing high for the first time, that is a bullish choke. The origin becomes a demand zone. I want to emphasize something here. Choke zones are special because they mark the literal turning point of a trend. You are identifying the exact movement control transferred from one side to other. When these zones get retested, they tend to produce very strong reaction because the other players there were the order that caused the reversal. Option C, break through an opposite zone. This is the third way criteria 2 can be met, and it is the most people don't know about it. I hope you are writing them down, as I only name them with criteria so to shorten the sentences. But if you did not write and forgot the criteria, you can wind back to recall. Here is the scenario. You have a demand zone that was created with a bullish break of structure, an inefficiency valid zone. But then the trend shift, the bearish shock form and create a supply zone above your demand zone. Now the supply zone is in control and the price is dropping. Price comes back down to your original demand zone and react, then it bounces. But here is the critical questions. Does that demand zone push price up strongly enough to break through that supply zone above it? If yes, demand zone is revalidated. It proves that the buyers at that level are stronger than the sellers above. The demand zone broke through the opposing supply zones. That satisfies criteria 2 in a powerful way. Yes, but if the price bounces from the demand zone and get rejected at the supply zone, fails to break through it, then the demand zone is weakened. it couldn't overcome the opposing supply. If this happened a second time, I consider that demand zone dead. This concept of opposing zone breaks is incredibly useful because it tells buyers in real time which side is winning the battle. When a zone can push price through the opposing zones, on the other side, that is a zone with serious institutional backing. Section number 7. Criteria number 3. Deep dive liquidity. Criteria number 3 is the bonus confirmation. It is not mandatory. Let me say it once again. But when it presents, it evaluates a zone from good to elites. There are two ways this criteria can be met. Way number 1, the zone sweeps existing liquidity before forming. This is the classic liquidity sweep scenario. Imagine you have a series of ruthless equal law on your chart. Every trader and their grandmother sees those equal laws and think that's support. They go long and place their stop losses just below those laws. All those stop losses are liquidity sitting there waiting to be taken. Now price dips below those equal laws. All those stop get triggered. Buyers who were long get stopped out. Their stop losses executed as sell orders. The institution used those sell orders as the other side of their massive buy orders. Then price explodes upward. The zone that forms right at the bottom of that sweep is extremely powerful. The institutions just grab their fuel and then peel their buy orders using triggered stop losses, and now they are letting price run in their direction. When you see a zone that formed right after a liquidity sweep, you know institutions were active at that exact level. That is not a guess. That is reading the footprint of smart money. The same thing works on reverse at swing high. Equal highs with stop losses sitting above them. Price spike up, triggered all stop losses, and institution peel their sales orders, then price dump. The zone at the top of that sweep is an elite support zone. Way number 2, price creates liquidity on the approach to a zone. The second way is when price creates new swing point as moves toward a zone for a retest. Imagine you have a supply zone off above and price is rallying toward it. As the price moves up, it creates swing lows along the way. Each of those swing lows represent a point where traders went long and placed their stop losses below. Each of those swing lows is fresh liquidity. When price reaches the supply zone and reverses, all those stop losses below the swing lows become fuel to the downside move. The more swing lows that were created on the approach, the more fuel is available for the reversal. So when you see price approaching a zone and creating multiple swing points along the way, that is actually a good sign. It means there is plenty of liquidity stuck off for the reversal to pit on. The best case scenario is when price approaches a zone, sweep a trend line of accumulated liquidity on the way and then enters the zone and reverses. You get the trend line liquidity sweep and the zone reaction all in one beautiful setup. Section number 8. Applying the framework on supply zone identification. Okay, a lot has been done right now. Let's apply everything into the real chart scenario. This is how I apply this framework to comes live. The very first thing I always do before making any zone is identify the overall trend. This is step 0 before we touch your zone drawing tool. You need to know the trend. If the market is bearish, I am primarily looking for supply zone, because in a downtrend, supply is being respected over and over again. Sellers are in control. Supply zones are where they keep reloading their sell orders. If the market is bullish, I am primarily looking for the demand zone. Buyers are in control. Demand zones are where they keep reloading their buy orders. So let's say we are looking at a 4-hour chart and we identify that price has been making a series of lower lows, lower highs, lower lows, lower highs, clear bearish trend. That tells us we are hunting for supply zone. Now I look for the most recent significant swing high in the trend. The area where price packed before drop to make a new low. I zoom into that area and run through our checklist. Criteria number 1, inefficiency. Did the drop from this level create a gap between the candle wicks? I look at the candles that cause the sell-off. I check the 3-candle sequence looking for gaps. If I find a clear visible gap between the wicks, yes, and the criteria 1 is met. If the wicks all overlap and there is no gap, I move on to the next swing high. Remember, no inefficiency means no zone under our framework. Criteria number 2, break of structure. Did the move from this level break below the previous swing low? If it did, that is a break of structure to the downside. Criteria number 2 is met. If the move from this level just sideways or didn't actually break any previous low, then criteria number 2 is not met and it is not valid zone. Criteria number 3 is liquidity. Was there any liquidity sweep before this zone pump? Were there any equal highs or trend line that got swept before the sell-off began? If yes, excellent. That is an A+ zone. If no, that is fine. It is still a B+ zone if the criteria 1 and 2 are both met. Once I have confirmed the zone, I mark it. I identify the candle or candle that present the origin of the moves for a supply zone. I typically mark from the open of the candle body to the highest point of the wick on that area. That red angle is my support zone. Then I wait. I wait for price to come back and test that zone. And when it does, that is where I look for my entry. I will explain in detail in the entry model section. Let me give you a second example to reinforce the process. After the first supply zone is identified and price has dropped and made a new low, I look for the next swing high. Price pull back upward, found resistance and drop again, making another lower low. I zoom into that pullback area and run the checklist again. Is there an inefficiency on the drop? Did the drop break below previous swing low? Was there any liquidity sweep? Let's say in this case, I find a clear inefficiency and a break of structure, but no obvious liquidity sweep. That gives me a B+ zone. Still valid, still tradable, but I note that it is not as strong as A+ zone that has all criteria. When I have multiple zone on my chart, I always prioritize the A+ zone over the B+ zone. If price is approaching both and I have to choose, I am taking one that trade at the A+ zone every single time. This process repeats throughout the entire trend. Every new swing high in the bearish trend is a potential supply zone. I run this checklist on each one. Some will pass and get marked on my chart. Some will fail and get ignored. That is the discipline that separates profitable traders from everyone else. Section 9. Applying the framework on demand zone identification. The exact process applies for demand zones in a bullish trend just inverted. I hope by now everyone knows by identifying a bullish trend as higher highs, higher lows, higher highs, higher lows. We are looking for demand zones. We find the significant swing low in the trend, the area where price bottomed before rally to make a new high. We zoom into each one and run the checklist. Did the rally from this level create an inefficiency? Did the rally break above the previous swing high? Was there any liquidity sweep below the swing low or below the trend line before the rally began? If criteria 1 and 2 are met, we have a valid demand zone. We mark it from the candle body close to the lowest wick in the area. If criteria 3 is also met, we label it A+. If not, we label it B+. Let me walk you through a special type of demand zone called extreme zone. Extreme zone is the very first zone that started the entire bullish trend. It is the origin of everything. Before this zone, the trend was bearish. At this zone, a bullish change of character occurred from the first time. Buyers overwhelmed sellers for the first time and shifted control. Extreme zones are the strongest zones on any chart because they represent the birth of a new trend. The institutional orders placed at these levels were massive enough to reverse the entire direction of the market. When price comes back to retest an extreme zone, the reaction is often very aggressive because those institutional orders were extremely significant. So when you are mapping out demand zone in a bullish trend, always identify the extreme zone first. That is your anchor. That is the most important level of your chart. Everything else is secondary to the extreme zone. After the extreme zone, I identify subsequent demand zones along the trend. Each new higher low that meets the criteria gets marked. Some will have all the 3 criteria, some will have only 2. I grade them accordingly, and I know which one is prioritized when price approach multiple zones at the same time. Section 10. Zone invalidation. When a zone is no longer valid. This section is critical, and I genuinely believe it is the biggest gap in the supply and demand education, because everyone teaches you about how to find zones. Almost nobody teaches you when to stop trusting them. Knowing when a zone is valid is the only half of the equation. You absolutely must always know when a zone is dead. Otherwise, you will be taking trade at levels that have no institutional backing left and wondering why the price keep getting stopped out. There are 3 ways a zone gets invalidated. Rule number 1, a candle closes through the zone with its body. This is the most straightforward invalidation. If a candle closes completely through the zone, not just wicks through it, but actually closes its body on the other side, that zone is done. The orders that were sitting there have been absorbed by the market. There is nothing left to push price back. Now I want to be very clear about the difference between a wicks through a zone and a body closing through a zone, because these distinctions matter enormously. If price wicks into a zone, meaning the shadow of the candle pokes into or even slightly beyond the zone, but the candle closes back on the correct side, that is actually a sign of strength. It means the zone was tested and it held. The orders at that level absorbed the selling pressure or buying pressure and push price back. That is a reaction and what we want to see. But if the candle body closed entirely through the zone, meaning the actual close of the candle is beyond the zone, that is different. That means the orders at the zone were not strong enough to hold. That have been consumed, that the zone is invalidated. Think of it like a well. A weak through is someone throwing a ball at the wall and the ball bouncing back. The wall held. A body close through is the wrecking ball going through the wall. The wall is gone. Rule number 2. The zone has been tested too many times. Every time price return to a zone, it fills some of those institutional orders sitting there. Think of the zone as a bucket of water. Each time price tap the zone, it takes a scoop of water out. Post touch, the bucket is full. That is a strong reaction and price bounces hard. Second touch, the bucket is half full. That is decent reaction, but noticeable weaker than the first. Third touch, the bucket is nearly empty. That means weak reaction or no reaction at all, and the price goes right through. As a general rule, I trusted a zone for a maximum of 2 touches. After the second touch, I consider the zone significantly weaker and I stop looking for threat at that level. If price comes back a third time, the order are likely exhausted and the zone will break. Press and touch zones are always the highest probability. If you have the choice between a press zone and a zone that already been tested once, always pick the press zone. If a zone has been tested twice, I am removing it from my chart entirely. Rule number 3, a strong opposition zone takes control. Context matter in trading. A demand zone might meet all 3 criteria and look perfect in isolation. But if there is a fresh higher time frame supply zone sitting directly above it, that demand zone is in trouble. The higher time frame always wins. If the 4-hour chart has a demand zone, but the daily chart has a massive supply zone right above it, the daily supply zone has priority. It represents larger institutional orders, bigger money, bigger significance. So always check the bigger picture. Don't just zoom into your trading time frame and ignore what is happening on the higher time frame. A zone that looks great on 1-hour chart might be sitting right underneath a wall of supply on the 4-hour chart. That changes everything. Let me summarize the invalidation rule one more time. A zone is invalidated when a candle body closes completely through it. A zone is invalidated when it is tested 3 or more times. And a zone is ineffectively neutralized when a strong opposed zone on a higher time frame is working against it. Write these rules down. They will save you from so many bad trades. Section 11. Common mistakes that destroy beginners. Before we get into entry module, let me save you months of frustration by going through the 5 biggest mistakes I see new supply demand traders make. I have made all of these myself when I was learning, so I am speaking from experience. So mistake number 1, drawing zones everywhere. This is by far the most common mistakes. New traders learn about supply and demand zones, and suddenly every swing high is a supply zone and every swing low is a demand zone. Their chart looks like a colored book with boxes everywhere. That is not how this works. The entire point of the 3 criteria framework is to filter. Most swings points are not valid zone. If you are making 12 zones on one chart, you are doing it wrong. You should have maybe 3 to 5 valid zones on your screen at any given time. Quality over quantity always. If a swing point doesn't meet criteria 1 and 2, it is not a zone. Period. Move on. Be truthful with your filtering. Less zone on your chart means less confusion and better decision making. Mistakes number 2, ignoring the trend. If the market is clearly bearish, stop trying to buy at every demand zone you can find. Yes, demand zones can cause temporarily bouncing on a downtrend, but the probability is not in your favor. In a downtrend, supply zones are being respected and demand zones are getting destroyed. That is what a downtrend is. Trade with the trend. In a bearish trend, focus on supply zones. In a bullish trend, focus on demand zone. Only look for a counter trend zones after you see a confirmed change of character suggesting the trend might be revising. Fighting the trend is how accounts blow off. Don't do it. Mistakes number 3, not checking for inefficiency. I see so many traders draw zones at swing points without ever looking at the candles that cause the move. They see price bounce and immediately draw a box, but they never check whether there is actually an inefficiency attached to that move. Without inefficiency, there is no magnet. Without magnet, you are just guessing that price will come back. And guessing is gambling, not trading. Make it habit. Every single time you identify a potential zone, the first thing you check is the candle. Is there a gap between the wicks? Is there an inefficiency? If not, move on. Don't take yourself into a zone that doesn't have them. Mistakes number 4, trading zones that have been touched multiple times. Fresh zones are the best. When a zone has already been tapped twice, those institutional orders are largely built. The fuel is running out, yet I constantly see traders making zones that have been tested 3, 4, 5 times and expecting them to hold again. They won't. So at least the probability drops significantly with each top. Always prioritize fresh and touch zone over zones that have already reacted multiple times. Mistakes number 5, not having a clear invalidation level. If you enter a trade at a zone and you don't know exactly where the zone becomes invalid, you have a problem. You don't know where to place your stop loss, you don't know how, and you don't know when to accept the trade is wrong. You end up moving your stop loss or holding on to losses, hope price will come back. Before you enter any trade, define your invalidation level. Know exactly where the zones is dead. Place your stop loss there. If price hit it, accept the losses and move on. That is professional trading. Anything else is emotional gambling. Section 12. How to actually trade this zone, the entry level. This is the section you have been waiting for. You now know how to identify zones, how to validate them, how to grade them, and how to invalidate them. But all of this is useless if you don't know how to actually enter a trade. Let me give you a clean, simple entry models that takes you all the guesses out. Steps 1 is identifying a valid zone on a higher time frame. I use the 4-hour chart or the 1-hour chart to identify my zones. These are the higher time frame zone chart. I map out the trend. I find valid zones using the 3 criteria. I grade them as A plus or B plus. This is my perception. Step number 2, wait for price to approach the zone. Once my zone are mapped, I wait. I don't do anything until price actually get close to one of my zone. I don't anticipate. I don't front run. I don't try to get in early. I wait price to come to me. This requires patience. Some things it take hours, sometimes days. But patience is a trade skill. This is the best setup that comes to those who wait. Step number 3, drop to a lower time frame and wait for confirmation. When price reaches one of my zone, I drop to the 15-minute or 5-minute chart. This is my entry module time frame. On the lower time frame, I am looking for one specific thing, a change of character in the direction I want to trade. Let me explain what this looks like for a demand zone trade. The price has been failing and it enters my 4-hour demand zone. On the 15-minute chart, price is still bearish. It's still making lower lows, lower highs within the zones. I am watching, but I am not doing anything yet. Then I see it, price making low within my zones and then push up and break above the most recent 15-minute swing high. That is a bullish change of character on the 15-minute chart. The lower time frame just signaled that buyers are stepped in at this zone. That is my entry. I go long right after the 15-minute chalk confirm. This is the key, and I don't enter the second price touch the zone. I don't enter blindly with a limit order sitting at the top of the zone. I wait for the market to confirm that the zone is being respected. On the lower time frame chalk is that confirmation. For supply zone trade, the process is reversed. Price rallying into my 4-hour supply zone. On the 15-minute chart, I watch for price to make a high within the zones and then break below the most recent 15-minute swing low. That is a bearish chalk. Entry confirmed, then I go short. Step 4, place your stop loss. Stop loss placement is simple. It goes beyond the entry zone. For a demand zone trade, your stop loss goes below the lowest point of the zone. If price closes through the entire zones, your zone is invalidated and you need to be out of the trade. The stop loss beyond the zone handles that automatically. For a supply zone trade, your stop goes above the highest point of the zone. Same logic. Don't place stop inside zone. Don't place it at the midpoint of the zone. It goes beyond extreme of the zone. Give the zone room to do its job. Price number 5, set your take profit. Take profit goes at the next significant level. For me, that is typically the nearest position zone or the nearest liquidity target. If I am looking from a demand zone, my take profit is at the nearest supply zone above, or if there is an obvious liquidity pole above the liquidity high, I might target that instead. If I am short from a supply zone, my take profit is at the nearest demand zone below, or obvious liquidity pole like equal loss. The key is that your take profit should always be at a level where opposing side is likely to step in. That is where trade's momentum That is where trade's momentum will slow down and potentially reverses. And here is a critical rule. Before entering any trade, you need to calculate your risk to reward ratio. Your stop losses distance is your risk. Your take profit distance is your reward. I don't take any trade unless the reward is at least 3 times the risk, ideally 5 times or more. If the math doesn't work, even if the zone looks beautiful, I skip that trade. The golden principles. Let me give you the golden principle of this entry model in one sentence. The highest time frame gives you the zone, and the lowest time frame gives you the entry. That's it. That is the whole model. You identify where to trade on a higher time frame and identify when and how to trade on lower time frame. One more minute. The higher time frame is your map. The lower time frame is your trigger. Section 13. Your homework assignments. I just give you an enormous amount of information, but information without practicing is completely useless. Knowledge doesn't become skills until you put it into repetition. So here is exactly what I want you to do after this video. Assignment number 1. Open a trading view chart. Any currency or any asset, it doesn't matter. Go to the 4-hour time frame. Identify the trend. Then mark every valid supply or demand zones. Using the 3 criteria checklist, grade each zone as A+ or B+. Be honest and strict with yourself. If a zone doesn't meet criteria 1 and 2, don't make it, no matter how tempting it looks. Assignment number 2. For each zone you marked, identify whether it is fresh or if it is already been tested. How many times price has touched it? Cross out any zone that are invalidated, either because they have been tested 3 or more times, or because a candle body has closed through them. Assignment number 3. Pick one fresh and touch A+ zone on your chart and set a price alert at that zone. When the price approaches it, drop to the 15-minute chart and look for a change of character entry. You don't have to trade it with real money. Paper trade it, simulate it, or demo trade it. But go through the entire process from zone identification to entry to stop loss to take profit. Experience the full workflow. If you want feedback, take a screenshot of your chart with your zones mark and share it into our Telegram or WhatsApp channels attached below. I actually looked through this and I will give you honest feedback on what you did and what you need to improve. Section 14. The last and final. Full recap and final thoughts. Let's bring everything together one final time. Supply and demand zones are area on the chart when institutional orders cause price to aggressively push away. This zone exists because the institution could not fill the entire position in one visit. When price return, the remaining orders can activate and push the price in the same direction again. The 3 criteria framework for validation a zone. Criteria 1 is mandatory. A zone must create an inefficiency. This is the magnet that pulls price back to the zone. 2, also mandatory. The zone must break structure or create a change of character or break through an opposing zones. This confirms the move was significant and not just noise. 3 is a bonus. The zone swipe or create liquidity. This adds institutional fuel and significantly increase the zone strength. Zone grade. All three criteria means A plus zone. Highest confident criteria 1 and 3 means B plus zone, still valid and tradable. Less than 2 criteria not valid zone, skip it entirely. Zone invalidation. A zone dies when a candle body closes completely through it. A zone weakens significantly after 2 touch and should be considered dead after 3. A zone is neutralized when a strong opposing zone on a higher time frame is working against it. The entry model identifies zones on the highest time frame, 4 hour or 1 hour. Wait for price to reach the zones, drop to the lower time frame, 15 minutes or 5 minutes, enter on a lower time frame, change of character. Stop loss goes beyond the zones. Take profit goes nearest opposite zone or liquidity target. Minimum 3 to 1 risk to reward ratio. The 5 common mistakes to avoid. Don't trade zones everywhere. Be selective. Don't fight the trend. Always check for inefficiency before making a zone. Don't trade zones that have been tapped multiple times. Always define your invalidation level before entering. That's everything. If you made it that far, you now have a deeper understanding of supply and demand than the vast majority of retail traders. But I want to be honest with you. Understanding is not the same as the skill. It comes from putting in the hours on chart. It comes from making a zone, getting it wrong, figuring out, and doing it again. Go do the homework. Put in the reps. Review chart every day. Within a few weeks of consistent practice, this framework will become second nature. You will start seeing this zone without thinking about it. That is when the real result start to show off in your trading. If this video helped you, make sure you like and subscribe. Drop a comment below telling me which section was the most helpful for you. It helps me know what kind of content to make next, and it helps other traders to find this video. I will see you in the next one, where we will go deeper into advanced entry confirmation and confidence that take this strategy to an even higher level. Until then, stay disciplined, keep it simple, and I will see you in the market.